Should you exchange your shares for Johnson & Johnson for Kenvue? Is Johnson & Johnson a buy now? And what exactly is my plan with my Johnson & Johnson shares? We're going to go through all of this today, as well as the offering that Johnson & Johnson have given to their shareholders to exchange their shares. We're going to also take a deep dive into Johnson & Johnson, their historical performance. We're going to take a look at their revenue, their bottom line, that net income, how that growth has been year on year. We're going to also take a look at the health of their balance sheet, their cash versus their total debt. We're going to then tie that into their dividend safety, look at some very important financial metrics for Johnson & Johnson. As always, we're going to run them through our stock valuation model, getting to our intrinsic value and our acceptable buy price given our margin of safety. We're also going to touch very quickly on Kenvue, the share, how it has performed since the IPO. And as mentioned, we are going to take a look at the exact details of this share offering. Now, Johnson & Johnson year to date is down 2%. It does trade towards the mid to upper end of the 52-week range and currently has a yield on offering of 2.74%. Shareholders who have held the company over the last 10 years would be up a respectable 95%, and that doesn't include dividends reinvested. As we can see, it's a nice graph upwards and ascending. So what exactly are Johnson & Johnson offering? Well, what we can see here when we take a look at their offer for separation of Kenvue Incorporation, if we take a look here and we can go through it together, essentially the exchange is going to offer will permit Johnson & Johnson shareholders to exchange some, all, or none of their shares of Johnson & Johnson common stock shares. So really it's your own choice. You can exchange some, you can exchange none, or you can exchange all. Now, what exactly is this going to be a benefit for the Johnson & Johnson shareholder? Well, straight away, for shares of Kenvue common stock at a 7% discount. So we can take a quick look here. Shares are trading at around $23, $24. So a discount of around 7%. Up to a limit of 8 shares of Kenvue per share of Johnson & Johnson common stock. So if you have, make it an easy number, 10 shares of Johnson & Johnson, you can change it for a maximum of 80 shares of Kenvue with a discount of 7% to the current market price. Now, if you don't want to do that and you want to hold on to your Johnson & Johnson shares, that's completely fine. However, what it says here, if the upper limit is not in effect, and not many people do end up exchanging their shares of Johnson & Johnson for Kenvue, the remaining shareholders will expect to receive around $107.53 of Kenvue for every $100 of Johnson & Johnson stock. So what we can see and what we need to understand here is, firstly, is it worth exchanging your Johnson & Johnson shares for Kenvue, or is it better just to hold Kenvue as a separate stock and hold your Johnson & Johnson as separate if you are looking to essentially enter into Kenvue as a stock in your portfolio? Well, Johnson & Johnson, firstly, let's take a look and do a deep dive on that company. So, income statement. Revenues, typically we like to see 3 to 7% growth year on year. December 2018, they had around 81.6 billion on the top line. January 2023, 94.9 billion. So nice growth over the period. What's also nice to see is that consistent increase year on year. Some years the growth was larger than others, but we can take a look at the specific percentages shortly when we look at the 10-year growth. Now, bottom line, that net income, we also like to see it directionally move in the same way. December 2018, 15.3 billion reported on the bottom line. January 2023, 17.9 billion. So it has also moved in line with revenue. But when we do take a deeper dive into the bottom line, we can see some inconsistency. So December 2018, it has in fact decreased over the 2 years after to 2021, for which it then increased quite significantly, around 50% to 2022, and then it decreased in 2023. So some inconsistencies here, which doesn't follow the revenue growth, but we will touch upon that shortly. Now, balance sheet health check, what I like to typically do, look at the total cash and short-term investments versus their total debt. So December 2018, they had around 19.8 billion on that cash in their balance sheet. Very, very nice to see. What's even nicer to see, latest quarterly report from a few weeks ago, they now hold 28.5 billion, so they have an even larger amount sitting on their balance sheet. Now, how does that 28.5 billion compare to their total debt? Well, total debt in 2018, they had around 30.5 billion. Now, latest quarterly report around 45.6 billion. So they do hold a significant amount of total debt, which is larger than the cash, and around 50% more than they had in 2018, 5 years ago. So let's take a look and see how that affects the dividend and some other important financial metrics. So 99 score on the dividend safety, making it very safe, the highest score you can receive. Market cap 452 billion, making it a mega cap company. Now, some metrics for those who believe we're heading into a recession. Recession dividend, they increased it during the last recession, 07-09. Recession sales, even though they had around negative 6% in sales, this was still above the average growth rate during the 07-09 period. And we can see again, whilst the return was negative 27% on the stock, it still beat the S&P 500's negative 55% return from 07-09. So very positive to see, especially for those who believe we're heading into a recession. Straight away, they've been paying dividends, increasing year on year for 60 consecutive years, making them a dividend king. They have that status as they've paid increasing dividends over the last 50 years. They have also been paying dividends for the last 107 years without a reduction. So an incredible feat for this company. Latest dividend increase of 5.3% in April this year, 6% compounded annually over the last 5 years, and 9% over the last 20 years. Excellent, in my view, one of the reasons why I hold this consistent dividend king. They pay out more than inflation, which is around 4%, given the US inflation rate over the last 40 years was 4%. And as I always say, you want a minimum 4% increase, salary, dividends, other income producing assets, or you are losing your purchasing power and taking a pay cut. So very positive to see. Now, in terms of dividend yield theory, it states a company is undervalued when the current yield sits above the 5-year average. As we can see here, I would say roughly in line, meaning reasonable valuation. Forward PE, again, roughly in line at 16 versus 16.6 for the 5-year average. So again, in my opinion, reasonably valued. Likewise, the third and final reasonable valuation indicator, it is in line with that sector PE, 16 versus 16.5. However, as always, we never look at any model in isolation and we'll draw conclusions towards the end of the video. And what we can see here is it is trading towards the upper end of the 52-week high. However, it does not mean overvaluation. Likewise, 52-week low doesn't mean undervaluation. Now, for those new investors who are tuning in, we only look at the free cash flow metrics as earnings is susceptible to manipulation by management through their accounting. So if you've seen my YouTube pinned video, you know one of my 7 golden dividend metrics is the free cash flow payout below 60%, as it means there's room to grow that double-digit dividend. What we can see here, for the last essentially 10 years, it has been below 60% other than 2022, which seems like an outlier given expected 2023 is to be 53%. So very positive to see. Likewise, free cash flow per share, $4.92 in 2013, $6.55 in 2022. It has been growing over the last 10 years. Some years more consistently than others, and some years we can see slight decreases. However, one of the positives we can pull out from this, expected 2023 at $8.95, meaning very nice, consistent upward growth and trajectory. So very, very positive for this dividend king. Now, sales growth, we like to see 3 to 7% steady moderate growth. We can see now on average it has been around that rate if you take an average over the last 10 years. However, we can see 2015 negative 6% and 2019, 2020 and 22 with 1%. So whilst it's not very consistent growth year on year, on average you would have to say it probably works out to be between 3 to 7%. 71 billion in sales in 2013 and 95 billion in 2022. Positive to see the increases year on year. So that's a very good positive for this dividend king. Now, shares outstanding. We love it when companies do share buybacks, returning excess cash to our shareholders. They don't do massive share buybacks. 2.88 in 2013, 2.66 in 2022. Small, consistent, a billion here or a billion there year on year. Nothing that's really going to drastically change your position as a shareholder, but it's just worth noting. ROIC, again, another one of my 7 golden dividend metrics. Above 10% is what I like to see, as it means there's room to grow that dividend, and also on top of that, it means that there is essentially faith in management in the way they're able to effectively allocate their capital. So above 10%, very good to see. We can see consistently between 18 to 23%. So that's a very, very big plus. Operating margin, free cash flow margin, not much to say other than they are consistently doing incredibly well, beating our minimum threshold of 12% and 5%. So very, very positive to see on their margins. Likewise, even though their debt was increasing over the last 5 years, it's still below the 3, which we look for when we look at the net debt to earnings before interest, tax, depreciation, amortization. Basically showing in 2022, it would take the company 0.5 years to pay off their debt net of cash on hand. And in 2023, it's expected to be lower. So very positive to see, no issues there. Hence why we can see that very, very strong dividend safety score of 99. On the right, purely information purposes, showing that 19% of the company's financing in 2022 was from debt as opposed to equity. As always, if you are enjoying the video, do hit that like button, do subscribe for continued content and join the community. And if you want to run your own company through these metrics and these models, do check the pinned comment and grab yourself a copy. Now, Johnson & Johnson, EPS 493, P of a company with no growth is fixed at 7, growth rate per analyst estimates at 18, and the current yield on AAA corporate bonds at 4.81, giving an intrinsic value of $113. We can see here that's well below the current trading price, showing signs of overvaluation based on this model alone. We then move on to the multiples valuation model. Companies in a similar sector and size, Merck & Co., AbbVie, Eli Lilly and Company, and Pfizer. We have the stock price, earnings per share, giving us the P multiples. Get the average multiplied by the earnings per share to give a multiples valuation price of $182, showing some upside to the current trading price, and thereabouts at the 52-week high. We then move on to the dividend discount model, the very consistent dividend king. We have the yearly dividends, average growth rate around 5.75. I've gone for exactly the same, as I believe they're incredibly consistent. If you do believe or think you can justify a higher or lower percent, do grab this model and do play around with the numbers to see what you prefer your growth rate to be. This gives a DDM price of $224, showing some very, very nice upside to that current trading price and well above the 52-week high. We then move on to the fourth and final model, the discounted cash flow model. We have the free cash flow year on year, average growth rate 3.6%, forward-looking per analyst estimates 9%. With that discount rate, gives us the present value of the future free cash flows and terminal value. Add that together with the cash, subtract the total debt, and get to our equity value at 517. Now, we then divide this by the shares outstanding to get a DCF price of $199. Again, upside to the current trading price and above the 52-week high. As always, if you are enjoying the content, do hit that like button. If value is being provided, do subscribe and join the community. Now, the intrinsic value is essentially the average of the four models that we have just run through, coming in around $180. Now, current price is around $173.85. Typically, I would say a margin of safety around 10% for a strong company, very strong financial metrics, wide moat, and essentially good forward-looking data. That would mean an acceptable buy price of around $161, and as we can see here, that's well within the 52-week range. For those who would be looking for a much higher 20% margin of safety, you'd be looking around $143, which isn't really within that 52-week range. Not to say it won't ever come down to that price. And those who are in between, around $152. As always, let me know your thoughts in the comments. Are you looking to buy, or even looking to sell, or purely on the sidelines? Wall Street are forecasting the price to go to around $184 over the next 12 months, showing some signs of upside and going above that 52-week high. Me personally, I was buying when it came down to the 150s and in the very low 160s. So for me, around 155 is a very strong price to enter into. Now, when we look and we take a closer look, in fact, at Kenvue, the stock that they're offering to exchange, we can see here it is currently trading at $23.72, which is around the mid to lower end of that 52-week range. It does offer a forward yield, although this says here 0.84%. I would need to check if that is correct, as I have thought it would be significantly higher, around 3%. Do let me know in the comments what the exact yield is. Year to date, the stock has been downward trending around 6%. So my thoughts before we leave the episode, I will personally be keeping my Johnson & Johnson shares. I don't want to be exchanging for a company that I've invested in with my investing thesis for the future, to change it suddenly for a company that I need to dig a bit deeper and see more financial results before choosing. Not to say I won't be investing in Kenvue separately in the future, but right now I will be holding onto my Johnson & Johnson shares. And when I get more data on Kenvue, I will take a look, share the analysis with you, and decide whether or not I will be adding this to my portfolio. As always, let me know your thoughts in the comments. Are you looking to do the exchange? Are you purely buying Kenvue as separately to Johnson & Johnson? Or even if you hold neither, what would you do in this situation? Or if you've had a similar situation with other companies that have done these offerings. As always, have a great day. Catch you on the next episode and take care.